So this is what I do all day long is assess given loan scenarios, and I can give advice as far as what might make the most sense for financing. It's really what I do when I'm not structuring loans and handling the loan transactions. I'm constantly networking, meeting new lenders, new debt funds, because when a deal comes onto my desk, I have my initial conversation. The more sources and the better ways that I learn to structure these deals, it makes the loan process easier and it solves a lot of problems.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Beau Eckstein.
Hello, and welcome to another episode of the Investor Financing Podcast. I'm your host, Beau Eckstein. And on today's show, we're going to talk about the basics of qualifying, or specifically, what does the property need to qualify for the different financing options for multifamily properties. So I get this question a lot by newer investors or investors that are used to investing in single family and maybe some duplexes and fourplexes. Now they want to start investing in larger 5+ multifamily properties, but they may not know that what they'll need in order to make this deal or transaction happen from the lending standpoint. And so I always just start out, okay, it's very similar. Everything is really basic questions, but really what the lender would want to know is property address. Where's the property? Is it in a major market or is it at some kind of tertiary market? What's the population? What's the occupancy level? Is it fully occupied? Is it 90% occupied? Is it 50% occupied? What's the deferred maintenance look like? What's the whisper price or purchase price? What's the plan? Is there any value add component? And then from there, we look at the debt service coverage ratio. Then we dive into the sponsor themselves. And in commercial terms, we say sponsor, or in residential, we say borrower. So in commercial lending, we say the sponsor. So what's the sponsor's background? What's their net worth? What's their personal financial statement look like? What's their schedule of real estate owned? Do they have any properties? Do they have any multifamily properties, 5+ units? Or is this their first one? Where are their real estate holdings right now? The reason we're asking these questions is because we're trying to assess, as mortgage advisors, we're trying to assess really what are the options based on the scenario from both the property standpoint and the standpoint of the sponsor or borrower. And then from there, we can kind of start giving a little bit of direction of what debt options might be on that property. So it could be a value add type transaction where it's currently 70% occupied and there's a $5,000 or $6,000 CapEx budget per unit. CapEx is basically renovation budget. And these are some of the differences that you'll see as I'm seeing more fix and flipper type investors that are saying, okay, we've got this fix and flip thing going on. We've got a couple rentals now. We're doing the BRRRR strategy, but now we want to kind of speed up our cash flow growth. And they look at multifamily as a viable option, which it is. But there's just some caveats that we need to know. And that's what the show's about today is the differences between residential or, investor type 1 to 4 unit properties versus commercial properties. And so I see a lot of people underwriting deals in tertiary markets. So that really, first things first is where's the property located? Because it's either going to be a debt fund or a bridge loan. It's going to be agency debt, or it's going to be a bank or credit union. And on some occasions, it could be HUD. Those are really your financing options for multifamily. Occasionally CMBS, especially if it's like a cardinal type of build, which is like a modular build. So there's different rules of thumb when certain property types cross path. Then we give advice as far as where to go for and what to expect on debt, and that's conversation today is strictly kind of what ifs. I'm getting a lot of newer investors, and I just wanted to kind of talk about the options out there. And I think a lot of newer investors could be better off. Let's say they have one or two rental properties. Maybe they do a fourplex. Maybe the next property is a 6 or 8 unit building. Those smaller multifamily properties are easier to finance. You can actually finance those on some portfolio programs or potentially a bank or credit union. Anything under $1 million as far as funds or debt funds is a little bit more challenging to fund than the larger loan. Actually, the 5 million, 10 million plus is probably the easiest. The 1 to 2 million is more challenging. The 1 to 2 million potentially could go agency if the sponsor meets the qualification of agency debt. If they don't, then you're typically looking at a bank or credit union.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Are you in the market for a commercial loan? Did you find the perfect opportunity but need funding? Have a special situation? At Find the Bank, you will get quotes with competitive rates and terms from multiple lenders without any hassles. Have a multifamily property, construction project, owner-user property, industrial, mixed use, hotel? At Find the Bank, you can get nearly any kind of commercial financing. The process is simple. Once you send us some information about you and your property, we send back a quote sheet. Then we quickly connect you with an advisor. You won't spend hours calling multiple banks trying to find the right person to talk to. We'll connect you fast to the right person, hassle-free. Better terms than you could get on your own. Go to findthebank.com and complete the form. An advisor will be connected with you within minutes to discuss your specific financing needs.
So this is what I do all day long is assess given loan scenarios, and I can give advice as far as what might make the most sense for financing. So I do that for multifamily. I do that for all different types of transactions. I have a gentleman right now buying a martial arts school. We're going to use SBA 504. So he runs a school right now, but leases the property. He's spending tons of money on his lease, and he can go and buy and probably cut his monthly outgo in half by owning the property. So that's an SBA 504. I'm doing another property where it's a conversion of an office building into a hotel, which even in this market with COVID, we're able to get things done like that. And we're using a SBA 7A with a pari passu conventional loan. I have another gentleman who's converting an office building into self-storage. And he's got a lot of money down on that. And he doesn't really want to jump through hoops of SBA. Could be an SBA deal, but we're going to just take that to a bank. So as I'm gathering information from the sponsors, the borrowers, and then I can assess where to take loans. So we place all different types of loans, from business loans that are maybe not real estate, could be a business acquisition of a roofing company, or it could be a franchise they're starting up. There's financing options for all these paths, and I dabble in all of it, I guess. And really what it comes down to is that there's a lot of financing options out there. And my strengths have always been is to find the right lender for the project, because so many projects are unique. I mean, granted, there are some cookie cutters. It's a agency 150 unit property. I mean, it fits the matrix of agency. The sponsors are strong. That's pretty simple. But these SBA deals are a little bit more in depth, unique properties. So it's just a matter of asking the right questions. And as a sponsor or borrower, having these documents ready that you need if whatever type of financing you're doing. Multifamily, hey, we know we need the T12. We need an interim financial statement. We need the current rent roll. We need a personal financial statement of the sponsors. Those are things we need. On an SBA deal, we need Form 413. That's a personal financial statement. We need a debt schedule, resume of the sponsors. There's certain items to ask for. But quickly, it really comes down to the advantage that a commercial mortgage advisor like myself or many others out there have is that we work with all different banks, credit unions, debt funds, non-bank SBA lenders. So really what we do is The value we provide is that we have relationships. We should have relationships and constantly building new relationships with all different lending institutions. So when a deal comes my way, I make it a point to be able to find a solution for it. And that's where, as a mortgage advisor, we can really excel, because if you, as a borrower, let's say you're buying a multifamily property and you go to one bank and they say, okay, well, the most in proceeds we can get you is 70%, a 5-year fix amortized over 25 years, versus maybe you come to me and I can get you a 7 or 10-year fix amortized over 30 with a better rate, better term, right? And it's because we don't just go, we're not just one, we source and shop loans for you, and also have relationships with credit unions and banks, which makes your job easier, because it's extremely frustrating to go and try to find debt, especially if you don't have a banking relationship in the area. And so that's really where we excel. I had a conversation with a gentleman yesterday, and he went to a bank. They wouldn't make the loan to him because he doesn't live in the market. So we navigate these issues. We understand banks and things, and we get around those. We find the banks that are open-minded. So there's like 20,000 small banks, regional banks, credit unions. I mean, there's probably even more than that. So it's really what I do when I'm not structuring loans and handling the loan transactions. I'm constantly networking, meeting new lenders, new debt funds, because when a deal comes onto my desk, I have my initial conversation. The more sources and the better ways that I learn to structure these deals, it makes the loan process easier, and it solves a lot of problems, because there's nothing more frustrating than a loan that just doesn't go through. You spend months on it, it doesn't go through. The borrower, the sponsor's mad. The banking world is definitely difficult, but knowing how to navigate it, you can navigate these situations and get financing that you need to help you leverage your business and grow your business. So anyway, that's my rant for today. Really appreciate you watching and listening to our episodes, and we'll be bringing many more episodes to you in the future. Thanks so much.